Hello viewers, welcome to the first live session on this NPTEL MOOC course on mathematical finance. We have received several questions on the spreadsheet that was shared to the students enrolled in the course. So I'll go ahead and address them one by one at a time. So Yash has asked if there is any opportunity for internship. So Yash, at this point, I am not considering taking any interns. Uh, then Aviral has asked a couple of questions. The first question is how valid is BSM in real world scenario? So the Black-Scholes-Merton framework has a lot of relevance in the real world financial markets. So the original, if you go back to the history of the Black-Scholes-Merton framework, you will see that it was originally designed in the context of valuations of assets and liabilities of corporation, and subsequently this became greatly applicable in case of option pricing. In fact, when it came prior to the Black-Scholes-Merton framework, option pricing was done in a sort of ad hoc manner, and there was a lack of credibility that was observed in the market. But once the Black-Scholes-Merton framework came, for the first time, one could see that there was an acceptable and there was a precise mechanism of uniquely pricing options, particularly European options. And interestingly enough, the Black-Scholes-Merton framework then found its application to a wide variety of different areas of finance beyond just option pricing, including things like risk management, and the rules within the framework of the Black-Scholes-Merton model, and in particular the results that were derived in the context of option pricing suddenly found applications in a lot of different contexts in other branches of financial mathematics, including, as I said, financial risk management and also portfolio theory. So the answer to your question, yes, it is relevant. And secondly, you have asked whether there are good books to understand the applications on numerical methods in finance. So obviously there are books. One particular book that is actually I'll recommend a couple of books. So if you want to do it from the point of view of applicability, one commonly used technique in finance is the Monte Carlo simulation, and there is a book by Paul Glasserman on Monte Carlo simulation and methods in financial engineering. So that is one book I can suggest. And if you are looking at more from the numerical PDE approach, when with regards to the PDEs that show up in pricing problems, as well as other areas of finance. So for that, there is a book on tools for computational finance by Rudiger Seidel. So these are the two books that come to my mind when you are asking about numerical methods in finance. So Ramakrishnan R has asked a very detailed question in the context of the 2008 financial crisis, and he wants to know the importance of ethical issues in finance. Well, it is a very important issue, and there are various ethical standards that are applicable to people who work in the finance industry, since they are handling an extremely large amount of money, and fund managers, they're handling savings, as you pointed out, savings of a large number of individual investors like pension funds. So people who manage these funds typically have to undergo an ethical training. In addition to that, in order to ensure a greater protection to small investors, especially with the money that has been parked in the bank, there are very strict regulations, and these are regulations. These come under a broader area of financial risk management, and these are what are called as the Basel Regulations. So if you go and look at the website of banks, you will see that there is a Basel Declaration which gives you a snapshot of the financial exposure of banks and what they are doing to mitigate it. So under the Basel regulation, they are required to keep huge amount of capitals. So that is, regulatory requirement. And as I pointed out, a lot of these fund managers, they have to pass some certification examination before they can actually be employed as financial managers. And those certification program typically includes ethics. And in case, but even then, there are chances that things can go wrong, for which there are these regulations which require you to keep capital in order to protect the investors in the event of something going wrong. So if you look at financial risk management, you will see that there are lots of capital requirements and primarily focused on things like credit risk, and there's market risk and operational risk, and along with it there is a host of other risks that are covered under such regulations. Lohit Kumar, he has said that he has appreciated the lectures, but he has pointed out some concerns about the assignments. So with regards to the assignments, what I want to point out to Lohit Kumar is that the lectures and the assignments are designed in a manner so that the assignments test the learner's ability to understand the topic, and is designed to test the understanding and the consequent ability to apply those concepts in case of concepts in case of the problems that you encounter. So I suggest that you have a closer look at the material being covered in the lecture, and you will observe that the assignments are essentially applications of those. And in case of any difficulties, of course, you can post in the discussion forum. Then there was another question. This was from Sahasram, and Sahasram asks a question regarding machine learning. And I'm not an expert in machine learning, but yes, machine learning in finance. It is beyond the scope of this particular course, machine learning. But I, of course, encourage you to look up machine learning, because data science is getting a lot of importance, and especially in the context of increasing complexities of the financial structure, especially financial derivatives. And you have talked about whether there is industry level certification, so that I'm not much aware of it. So you'll have to look up, at digital resources to see if you can find something. Also, you have asked regarding real projects using large financial data sets. So large financial data sets, if you want, in the sense of a large number of data sets, very microscopic, as well as over a long period of time, you will then actually have to, most of this is proprietary and commercial, so you'll have to make use of some commercial services for obtaining that. But of course, in the public domain, you can get some basic data, then you can use as a starting point to carry out tests with some real life, scenarios. And but for large data set, of course, you'll have to resort to buying proprietary data sets that are available with. There are several such providers who make such data sets that are available. Okay, let me just look at the spreadsheet and see some more questions. Uh, so, Amrish Chandra has asked some the content of the course suffices for the purpose of getting a corporate job. So that's a very open-ended question. The only thing I can say in this context is that the contents we discuss in the course, they do have relevance not just in the broader area of mathematical finance, but also they have relevance in other key areas of financial services, such as portfolio management, asset management, and financial risk management. So, this is what we had on the spreadsheet. So let me now move on to So Nikhil Ranjan Agarwal has asked that after this program, what are the job opportunities? So I mean, this course is intended to give you an idea into mathematical finance, and you know, one of the areas that you can work on is if you intend to work in banking sector, especially as far as the derivatives trading and derivative pricing are concerned. And also, if you have to look up a little bit more on portfolio management and financial risk management to have a better clarity on the job opportunities that are available. Um, so we have a couple of, so Ramakrishna has responded, and then Sahasram has also responded, written on the post. So, okay, so now all the questions that have been posed, I believe, have been addressed. So in the chat box, if you have any other questions, please feel free to, you know, post them, and I will address those. Oh yes. So Ramakrishna has asked that there is a regarding my earlier observation that increasing complexities in the structure of derivatives. So what happens is that there are teams which work. So as an individual person, uh, there are two sides of this question. One is that how can a person participating in that market derivative understand this complexity in the structure of derivatives. So by you are referring to a person, so it is not clear whom you are referring to. So I will try to answer the two from the two point of view. See, from the if this person that you are referring to is an investor, so obviously it is extremely difficult for an investor to figure out the complexities of the market, but they will have a broader idea. And because it is difficult for an individual investor to work out the nitty-gritties of this the market mechanism, that is why you need these fund managers, risk managers, or quants as they are called, to take care in assessing those complexities, designing financial instruments, advising you on investments, and also ensuring that the risk factors are taken care of and protecting the interest of the investors, and also ensuring that the ethical standards are being followed. So if you look back, so at the end of the day, the answer to your question is that at an individual level, uh, it is difficult for an individual investor to completely understand the intricacies of the entire setup, which is why they typically would go to a financial institution to help them out with the process, because financial institution has a team of such individuals who are qualified and have the skills in order to deal with these complexities. So Dr. Santosh Kakre has thank you for your appreciation for the course. Thank you, Ramakrishnan. Thank you, Dr. Nikhil Ranjan. Thank you, Amrish. So I would welcome more questions from your side. So please type in the chat box. Yes, I had already responded to your question. At this point, I'm not taking any internship to any interns to work with me. Amrish Chandra. So, you said that you believe multivariable calculus is of utmost importance. Well, multivariable calculus, I think the reason why you have made this observation is driven by the fact that you are looking at the optimization aspect, but it does not play a very big role. But any book to refer to it, you can look up any undergraduate texts in mathematics honors or multivariable calculus. One book that comes to the top of my mind is the book by James Stewart, so you can consult that. Okay, so Santosh Kakade, so you said that you want to focus on the assignment starting now. So is there any questions, specific questions that you had with regards to the assignment, or is it a general statement that you are making? In the meanwhile, Indranil Chaudhary had asked an application of MATLAB in finance. Well, in this course, we don't have the provision for MATLAB in finance, but in the other course that you have taken on mathematical portfolio theory, I will spend a week on talking about how to use mathematical MATLAB in finance. So I believe since you are registered for that course, you will get access to MATLAB, so you can explore the financial toolbox. So for MATLAB, there is a financial toolbox which has a lot of important resources. So Indranil Chaudhary, you can start working on that MATLAB financial toolbox, and of course, in the other course in mathematical portfolio theory, we will come and I will discuss that in the last week. Oh yes, so Ayushi has asked this question that she is a graduate in BSc Finance. So Ayushi, can you please tell me that where are you doing your BSc Finance? I mean, is it more on the finance side, or is it the is it more on the mathematics side? In the meanwhile, I want to ask that yes, if you want to become a quant, programming is of course very important. If so, what language? So that will depend on the place you work in. But I believe that a good place to a good skill to acquire. If you want to learn programming, keeping in mind your goal of becoming a quant, I would recommend R or Python. So, Python is, of course, a very well accepted language for data science. And since a lot of statistical techniques are involved when you are doing analysis of financial data, so R would be another appropriate language to pick up. So Ramakrishnan R is saying that in my master's degree, we have dealt with volatility in the prices of derivatives using Arch family, but I found that most students point out the same result, that prices are volatile. What are your views? Ramakrishnan, I do not. It's not clear to me exactly, what observation you are making here. Also, I am not completely familiar with the Arch model. So I find that most studies point out the same result, that prices are volatile. Of course, prices are volatile. That is the reason why you study pricing models, because mainly because of the volatility. If there is no volatility, there would not be much mathematics on it. So Ayushi has said that she studies core finance. You have bond mathematics. So bond mathematics, I presume you mean bond pricing, and bond risk management such as duration and convexity, Black-Scholes model, portfolio theory, analytics using SAS and SPSS. Okay, so Ayushi's program is a blend of Black-Scholes bit of mathematics, economics, statistics, as well as statistical software. She uses SAS, but as I pointed out earlier in response to an earlier question, please try to see if you can find some time to learn R or Python. So Santosh Kakara said that, is there any other way to be in touch with you this sort of queries? Well, we don't have provision for a WhatsApp group of participants, but what we in the discussion group. Please feel free to post your questions in the discussion group, and I try my best to respond within 24 hours to your queries. So you're welcome to post, as many queries, as you might have on the discussion group, and I will, I will, as I said, I will try to address them within a day. So we still have some more time. So I would like to invite more questions from your side. So no other questions. I was hoping that there will be some more questions. You still have half an hour or so left. Okay, so Ayushi has asked another question. What core skills or concept areas do I need to improve upon to learn about backtesting or test testing trading strategy? Okay, so backtesting or stress testing, of course, you will require to know statistics in order to handle that, and also you will need to uh, well, I mean, at the end of the day, you will need to make use of concepts from data science, and the data science heavily relies on statistical techniques. So I would say that if you want to learn more about this backtesting or stress testing in the broader paradigm of modeling, I would say statistics and also a programming language like R or Python. In fact, stress testing is a very important aspects of financial markets, financial modeling, and a lot of stress testing and has to be done, and backtesting has to be done before you start using a particular model, uh, in real life situation with real money of people. And also regarding stress testing and backtesting, you need to know, go through Monte Carlo simulation. So that is another very important concept in finance, as far as practical applicability is concerned. Okay, Ramakrishnan, I don't know. I'm not a game theorist, so I really I do not have much idea about how game theory is used in financial market transactions. You see, mathematical finance is an extremely broad area. So yes, I'm sure you can find applications of game theory. Okay, so will there be a model paper before the certification exam? No, we do not have a provision for the model paper before the certification exam. But I suggest that you, before the certification exam, you please go through the assignments, uh, and I believe that will give you some idea about the certification exam. Okay, so you know, can you, if anyone has any other questions, can you please post them in the next 4 or 5 minutes? So please try to post your questions for the next 4 or 5 minutes. Anything else that you would like to be addressed during this live session? Okay. Malayala has written that in which branch this mathematical finance is there. So can you please elaborate what you mean by in which branch, so that I'm in a better position to address your question. In the meanwhile, Indranil Chaudhary has asked, will there be more live sessions? Yes, I believe we'll arrange for some more live sessions. Yes, we'll have more live sessions as the course progresses. And of course, in the meanwhile, you can always post in the discussion group. The answer to your question is yes. So Malayalia, can you just please specify what exactly do you mean by this branch? In the meanwhile, I'll just try to respond that mathematical finance is a very broad area which draws tools and approaches from a lot of different branches of mathematics. So on one hand, as you have already seen that you of course need a probability theory, you need statistics, you will need to know programming, you need Monte Carlo simulation, and you need to know numerical PDE approaches if you want to do theoretical aspects of the computing prices. You need to know, also have to, more importantly, have to have a great amount of clarity as far as understanding the financial markets is concerned. So it is a very broad spectrum over which this subject is pervasive. uh, and also even that there are people who do economic physics where you can actually even use tools from physics in order to work out problems of things like extreme value situations or outlier situations in case of finance. Okay, so Ramakrishnan has posted another question. In India, the stock market participation is extremely low and derivatives are not even developed completely. So, what are your views on this? Well, I mean, I don't know what is, what do you expect, you know, in, as far as my views are concerned. From whatever you have said, I mean, that is how things stand. Uh, and I don't want to make any observation on this. This is a very generic, open-ended thing. If you have any specific questions, I don't know why this has happened. One of the things that I've observed is that a lot of people are not aware of what is a derivative and what purpose can it serve. But I believe, over time, people will become more aware of derivatives, such as an example of how one can make use of futures in order to protect their investment. So that is one example. Okay, so what is the future scope for data science in finance? Well, I hope that standing today, as we look forward, I'm sort of there's, in my opinion, I can see that data science is likely to play a very big role in finance because at the end of the day, a lot of it has to do with handling past data in order to make better investment decision and risk management decision. So as we are moving slowly towards a data driven society, of course finance will also see a significant presence of data. That is what I believe. Okay, so Ramakrishnan is saying that what are the reasons that there is a low participation in assets in equities and derivatives market? And as I briefly pointed out in my earlier response to this question, that one of the reasons that I can see is that there is not a lot of awareness about what a derivative is, what it constitutes, what purpose it serves, and I think it also has to do with the understanding. People might have some reservations about getting into equity markets, but I think as things are changing, especially with the coming of mutual funds and pension funds and so on, I think people are becoming more aware of the equities market and as well as derivatives market. So I think over the time, as more awareness gets into the system, people will uh, consider equities and derivatives as a potential investment option. Okay, also to build a career in mathematical finance quant, how relevant are CFA or FRM programs? Yes, I believe that they are important. Or let me say, instead of emphasizing that they're important, I'll just say that CFA and FRM are well established financial certification programs. So, and certainly, they can help you not only learn the subject, but I think also, from what I understand, the banking sector, they are also looking for people who are qualified as CFA, or they have a CFA charter, or they have the FRM charter. So actual mathematics, so Amrish Chandra is saying that actual mathematics is more or less same as mathematics in financial risk, or they are totally different. Yes, as you have rightly pointed out, actual mathematics also there is actually a lot of overlap between what you do in actual mathematics and financial risk management. So in fact, there are many tools, as I pointed, such as the Black-Scholes modern framework being used in credit ratings and in estimating credit risk in order to assess corporate assets and liabilities, and then in financial risk management and optional pricing. So in a lot of apparently different and distinct areas of finance do have a lot of overlapping mathematical and computational tool that are being used. So in this particular case, another example of this is that actuarial mathematics and financial risk management have a lot of overlapping approaches, and this is also manifested by the thing that if you look carefully at the Basel regulation or the solvency regulation for insurance, you will see that there are overlapping things. So Dr. Nikhil Ranjan has said that, in my opinion, Indian believe in investing as a traditional and without risky avenues, bank deposits, property, and that's why. Yes, that is exactly what I was pointing out. That there is one point, one aspect is that there is not much awareness, and of course, as you pointed out, I agree with you. The other notion is that this is a traditional viewpoint, or what in the parlance of finance we will say as risk aversion. So from that point of view, I think it's a combination of risk aversion and of course a traditional held viewpoint. That is the reason why people prefer uh, things like bonds, fixed deposits, and property and gold and so on, which are seen as being more stable as compared to the more modern uh, financial instruments, particularly derivatives. But people recognize the importance of forwards and futures as some sort of a protection against adverse movement of the underlying asset. I think you will see more participation in derivatives market also. Well, I don't know what you mean by multifractal analysis. Can you please elaborate a little bit on it, Ramakrishnan? So can you please say what do you mean by good course? So you said that, can you suggest, Hedvi Shah has said, can you suggest some good course for master's degree in computational finance? Well, if you are looking for a specific course, as I suggested earlier, you can look up some books on computational finance. Programs, again, you have to look up on on the internet, and you have to figure out what suits your interest as best. At this point, it is difficult for me to recommend any specific program at any place. Okay, so what is this, Ramakrishnan? Can you please say what do you mean by EMH? I'm not aware of this term. So, Idris Chaudhary, which one has greater depth? So, can you please elaborate as to what do you mean by greater depth? In terms of mathematical content, I believe that you will find that mathematical finance is going to be a lot more mathematics as compared to mathematical portfolio theory. So, Ramakrishnan, can you please elaborate? What do you mean by EMH? Okay, efficient market hypothesis. Yes, so you're saying that multifactorial analysis is finding out if there is any pattern existing in the data set. Uh, so, EMH, efficient market hypothesis. Multi-factor analysis is finding out if there is any pattern exists in the data set. Okay, I'm not familiar with the multi-factor analysis, but yes, observing patterns existing in the data set to make predictions is in vogue. So if you look at what high frequency traders do, what they do is that they basically look at patterns, and also they make use of the information that is they receive slightly early in order to make a profit. And of course, at the end of the day, any investment strategy has to be driven by making use of historical data. And certainly, as you are suggesting, that could include pattern recognition from the historical data. Okay, so Avnish Chandra say FRM is too costly for me. Yes, FRM is an expensive exam. I understand that. But I don't know of any other low fee certification observed by the Indian capital market regulators. You could look up the website of Reserve Bank, SEBI, and see, to see if they are offering any such program. But I cannot, vouch for anything that I'm not really familiar with. But I believe you will be able to locate something on the website of SEBI or any of the institutions that have been established by the market regulators. So first of all, I suggest that you please identify that they do have recognition by the regulatory authorities domestically before you actually consider any such certification program. A lot of these questions are coming as sort of a generic questions. I'm not getting a lot of questions about the specific course material. So is there any other question that you would like to post? We just have 14 people watching. I thought that we had a lot more students than that. So in the next few minutes, can you please post your questions? Any final questions that you might have? Thank you, Amrish. Okay. So Ayushi, I don't have I covered have you in the course material? I don't think that we have arrived at convexity. So I'm guessing that you are asking this from a more general point of view. So what happens is, so let me explain this. First of all, the notion of risk as a result of interest rate movements in the bond price. So what happens is that in case of a bond price, your interest rate movement can affect the price of the bond. So that means that if you purchase a bond, a 5-year bond today, and after 1 year you decide to sell the bond to somebody else. So at that time, the money that you receive from the bond is going to be slightly different, is likely to be different in case the interest rate moves than what you would have expected to get at the end of 1 year when you first invested in the bond. Now, what happens is that basically, in a very generic sense, this change in the bond price as a percentage of the original bond price that can be estimated using duration and convexity. So basically, that change in the bond price as a percentage change in the bond price as a result of interest rate movement can either be approximated linearly, just linearly by involving the duration. But if you want a greater amount of accuracy and you want to get a second order accuracy, then you bring into the convexity into the picture. So convexity, I'm not going to just the mathematical definition, but I'm saying that convexity, so I mean the basic measurement of the change in the bond price is given by duration, and convexity gives an added uh, added accuracy, or contributes to an added accuracy in the estimation of the percentage change in the bond price. So, or it offers an improvement over the estimate of the change in the percentage change in the bond price over and above what is given by duration. So you can view this as some sort of second order or higher order approximation to the change in the bond price resulting from interest rate movement. And interest rate movement, if the interest rate goes down, then the bond price goes up, and and vice versa. So if the interest rate goes down, bond price goes up. If the interest rate goes up, then the bond price goes down. So as a bond holder, you expect that the interest rate is going to go down, so that you actually get a higher bond price than you anticipated. And this movement in the bond price is estimated using duration and convexity. Okay, so learn French, he says, suggest some basic books to start to learn. So that the books that I am referring to for the course, my co-instructor and I are referring for the course, have been identified in the course description, the main page of it. So you can have a look at those books. I don't remember if in case, so if you want to learn some very basics about financial markets, derivatives, and so on, uh, then a good place to start is to look at the book by John C. Hull. So John C. Hull has a very well-known, globally accepted book on options, futures, and other derivatives. So that is the most basic book that I can think of, which I think would be useful if you want to if you're looking at a starting point. Okay, Ramakrishnan. Well, I mean, that is certainly a plausible formula for uh, volumes per trade, but you also have to take into account that company ABC might be trading in other exchanges also beyond just BSE and NSE. So how do you factor that in? And you might even be having, for example, company ABC listed in New York Stock Exchange, or maybe London Stock Exchange, or all around the world. So in principle, whatever you said seems sort of logical, but it might not offer you the complete picture of what is going on. But yes, your uh, formulation is logical if the company ABC is trading only on BSE and NSE, exclusively on these two exchanges and no other exchange. So we have just a few minutes of the scheduled session left. So please post your questions. We have about 10 minutes of this session left. Thank you, Ramakrishna. You have asked a lot of interesting questions. Any other questions? So 2020 pandemic is an exception outlier. So how does the traditional theories like modern portfolio theory account for it? Okay, this is a tough question to, to answer because since the advent of this uh, modern portfolio theory, which came in 50s, or this option pricing theory that came in early 70s. I don't think we have had such a global and widespread disruption to economic activities. So at this point, it is very difficult for me to actually address this question. I think you will need some more time to see how this pandemic has affected, because you see, and also calling it an exception or an outlier. You see, an outlier typically we would reconcile it to a sudden, isolated event on a small time scale. But what is as it the pandemic is actually it is no longer an event that is happening on a very small time scale. It is happening on over a large time scale. So I think that at this point, as I view it, I don't think that our understanding of modern portfolio theory or the mathematical finance, as it has evolved in the last 40 years, or an exceptional outlier theory like germ diffusion models or extreme value theory can fully reconcile and explain the behavior that you have observed. I think we need to give it a little more time and more data sets in order to assess the impact of the pandemic from the point of view of how the models are able to capture the dynamics during this period. So we have to give it a little more time. Thank you, Learn French. Thank you, Ayushi. So Ramakrishnan, you can just post it on the discussion forum, and I'll respond to your queries. I'm sending it to my email ID. It's sort of it will be difficult to manage, and also if you post it on the discussion forum, anything, any question that you raise, and my response to it would be accessible to everyone. So I strongly encourage you to use the forum for this purpose. But you're of course welcome to pose as many questions you know that you have in mind on the forum. So we have about 5 minutes or so left for the session. So anyone has any closing remarks or any final questions before we wind up for the day? Thank you, Ramakrishnan. Yeah, you have asked a lot of knowledgeable questions. Thank you, Dr. Nikhil Ranjan Agarwal, for posting your questions. Pratik, can you please be a little more elaborate as to what do you mean by rephrase? What Ramakrishnan RS said is basically volume means the number of shares that have been traded. So what he wants to know is that per trade, how many shares have been traded. So for example, if there were 10 transactions and the total number of shares that are traded is 10,000, then per transaction the number of shares traded is 10,000 by 10, which is equal to 1,000. Yes, Dr. Santosh Kakre, thank you for your appreciation, and certainly I look forward to your questions for the next live session. In the meanwhile, please feel free to post your questions on the forum. Amrish Chandra, thank you for joining us and asking several questions. Okay, so we have a couple of minutes more before we wind up this session. So any final question? Maybe I can take one or two more questions. Or this discussion forum. So if you go to the main portal where you log in, where you have the assignments and all, on the top there is a link where you can ask a question. So you can click that link and you can post your question. So it's like a Google group forum, and then I will respond to that. So in fact, all the questions that have been asked so far, they are all archived there and is visible to the people who are enrolled for the course. Can you, Amrish Chandra, can you please specify the lecture number that you are referring to? I am presuming you are referring to lecture number 8. Oh, so here basically there is a region on the hyperbola, and that particular region is the region that for which no short selling is actually allowed. So that means that all those weights which are greater than or equal to 0, that means there is no negative weight in your portfolio. Whatever resulting values of mu and sigma that you have, that is the one that shows up in the part of the hyperbola that I have identified in the lecture. Again, I don't, it's not, your question is not clear to me, Amrish Chandra. Okay, Pratik says, sir, can you calculate the overall trade means of volume for any exchange in the market or the firm? But you can apply this to, yes. So what you can do is that, the information that you have regarding the number of shares that have been sold, that is available per day, number of units of the share that is available, and that the number of trades or number of transactions that were used to purchase that many shares are available, so that you can you can use to calculate the overall trade volume. So you can use it to calculate that will give you the total number of shares that have been traded for each company, and then you can also collate all of them to get the overall number of the total number of shares that have been traded overall in any exchange. So there is no need to calculate. I mean, these numbers should be typically available. The number of trades for each asset. So either they will be available in the public domain, or typically I expect that on the exchange that these numbers would be available. And then you can sort of collate and use a formula to calculate what is the overall number of trades and other matrices that you want to take care of. Okay, Amrish Chandra, your question is still not clear to me, and we are also kind of running out of time. It's already 1 o'clock. Can you please post your question in detail on the forum, and I'll respond to that? Is that okay? And can you please describe your question a little more detail so that I'm in a better position to answer your question specifically? Yes, yes, sure. And I look forward to your response to your post and your question, and I'll try to address it as soon as I can. Okay, Pratik, thank you. If you have any further questions, so we have come to the end of our scheduled time for the session. So, is there any question that you still have? You're welcome to post it in the group. And it was a very interactive back and forth. So yes, to the layman, the significance of mean variance and standard deviation is mean will give you the average return that you can expect, and variance and standard deviation will give the concurrent risk that is associated with that particular asset. Okay, so I think we can call it a day with this session coming to an end. Thank you all for joining and asking so many questions, and it was a very interactive experience, and I look forward to the next session. And as I pointed out, in the meanwhile, any questions, please post it on the forum. Thank you again to all for joining this.